How to interpret and analyze cash flow statement, income statement, and balance sheet, and how to combine different parameters to create ratios and analyze them. Namaskar, hello, and welcome, friends, to this advanced financial modeling, stock research, and valuation course. This course is for investors and finance students who are looking to understand how professionals value stocks. The course comes with a dual certification program. One is for the course completion and one is for internship completion. So, for those who are interested in enrolling to the course certification program, the details are given in the description and in the end of the video. You can check that out. Meanwhile, the entire course material is available freely on YouTube, like this video, so you can learn it freely anywhere, anytime. Students who are pursuing courses like MBA Finance, CFA, CA, CPA, MCOM, BCom have all taken this course and benefited from it. If you are an investor or if you are a finance student, this course is for you if you are looking to understand how professionals value their stocks. What is the eligibility for this course? The good news is we have structured the program assuming that the viewer is a beginner. So, from a beginning stage, if you do all the assignments and all the chapters one by one without skipping them and applying them hands on, then by the end of this course, you are assured to have an advanced level knowledge of how stock valuation is being done. And regarding the course content, let us discuss that now. First, we come to the stock filtration. Any stock exchange, if you visit, you will find that there are thousands of stocks. For example, Nasdaq has more than 3,000 stocks. NSE and BSE together have around 8,000 stocks. So to begin with, we need to find out a way where we can filter out all these thousands of stocks and reduce the number to a manageable list which we can do deep analysis on. In the first assignment and first chapter, we show you an efficient way, an intelligent way of segregating the stocks and filtering them out. In the second chapter and second assignment, we try to understand how to interpret the cash flow statement, the balance sheet, and the income statement and bring them together to do ratio analysis. Ratio analysis brings us to chapter 3 and assignment 3. In chapter 4, assignment 4, we are going to study together in a detailed way how to do discounted cash flow valuation. Apart from that, we will also learn how to do dividend discount model valuation and residual income valuation. After learning how to do discounted cash flow valuation, we get into detailed reading of an annual report. We take a company which is listed in the stock markets and we read the annual report together along with you. After learning discounted cash flow modeling and valuation, we move into valuation of financial institutions, that is, banks, NBFCs, etc. The valuation of banks and financial institutions is a bit different than the typical manufacturing company or even an IT company. So we understand how to mathematically value a bank or a financial institution in this assignment. This is assignment 6, chapter 6. Assignment 7, chapter 7 is about understanding the monetary system and the currencies. We delve deep into the history of monetary system, the evolution of currencies, and the impact of central banking policies and the state's financial and monetary policies on the economy, especially during recession times. In the last chapter, that is assignment 8, chapter 8, we move into understanding the specific analytical parameters for specific industries and specific companies. For example, a mining company is analyzed differently than a retail company. A retail company is analyzed differently compared to an IT company. An IT company is analyzed differently compared to a banking company. So specifically, each of these industries have some specific parameters. We understand what those parameters are and how to understand them in this last assignment. And once all these things are over, the main goal is for you to become capable of valuing stocks like professionals do and creating reports like professionals do. So without further ado, let's get started. How to interpret and analyze cash flow statement, income statement, and balance sheet, and how to combine different parameters to create ratios and analyze them. Our assignments 2 and 3 are all about this. Assignments 2 and 3 comprise of 5 segments. In the first segment, we understand balance sheets. In the second segment, we understand income statements. In the third segment, we understand cash flow statements. In the fourth segment, once we are done with analyzing the financial reports, that is cash flow statements, income statements, and balance sheets, we get on with ratio analysis. And in the fifth and the last segment, we take a real listed stock and understand its financial statements and do its ratio analysis. Now begins the fifth and the last segment where we select a listed company, a real listed company, and analyze its financial reports and do its ratio analysis. Let's begin.
So friends, this time we are going to do the assignment 2 and 3, and this is basically a demo for it. So some of our friends wanted to see a demo how to do ratio analysis practically with a single stock or multiple stocks. And assignment 3, as I have shared the videos with you, they are mostly about understanding the balance sheet, understanding the cash flow statements, and understanding the income statements and their efficacies. So these 4 things, basically ratio analysis, income statement analysis, balance sheet analysis, and cash flow statement analysis, these 4 things go hand in hand. You cannot actually separate them. So now we will do a demo with a stock called Eicher Motors. I will myself try to analyze it in terms of these 4 aspects. So let's start. First, what I'll try to do is understand a few of the liquidity and solvency ratios. First, let's say I'll check what is their current ratio. Current ratio is 1.15. It is marginal, but okay. Now this current ratio absolutely in absolute terms is average. If I want to see a comparative analysis of it, what should I do? We just simply go downwards. There is a place called peer comparison, right? Here we press on edit columns. In edit columns there is ratios. Now here we search current ratio. Here there is current ratio. So I pressed on the sector link. We went into the page which has all the sectors. Now here we can see the current ratios. So the top 15 companies according to market cap, in that Eicher Motor has a current ratio of 1.15, while Maruti Suzuki has a current ratio of 0.87. Tata Motors 0.97, Mahindra & Mahindra 1.3, marginally better. Bajaj Auto marginally better. Then Hero MotoCorp a little better. Escorts in a far better position, 3.15. And VST Tiller Tractor, this is also in a far better position. So in terms of current assets, we can say it is in a very average position, and actually a little below average, but the number in absolute terms is okay. So this is basically a liquidity ratio. We also have to check the solvencies, and if we have to check the solvencies, now I will try to check one more thing, which is the interest coverage. Now let's see where Eicher Motor is, 103. So in the top 15 companies, there are 3 companies with triple digit interest coverage, which is fantastic. Means they do not have any debt. Their debt is next to nothing. So this is a very good thing. Actually speaking, this is a very good thing. So they are maintaining a parity between current assets and current liabilities, so that their working capital load is balanced with the help of current liabilities. That's what the conclusion seems to be till now. Now let me check the working capital also. Here it is, working capital. Working capital for Eicher Motors. See, the number is quite small. So they are requiring for this kind of a revenue. Let me see where the sales is. 16,000 crore revenue they have, and they have only 700 crores of working capital requirement. While there are other companies which have revenues of, let's say, 40,000. So if this is 40,000, that means 2.5 times. So 2.5 times of 700 should be around 1800 or something. But see the working capital that this company is requiring, TVS Motors, 13,000. It should have been around 1800 if the working capital parity was there. Another company, Bajaj Auto, this has a revenue of 44,000. So this is around 2.75 times. So this should have around 2,000 crores of working capital, but this has around 4,000 crores of working capital. So this is much more comparable, and that reflects in the current ratio also. You can see this is 1.3 and this is 1.5. So instead of 2000 they are using 4000 crores. Right. In terms of scale parity, they should be around 2000, but they are using around 3800 or 4000 crores. Mahindra and Mahindra, they have a revenue of 1.4 trillion, so which is around 8 times of Eicher Motors. So their working capital should be 8 times more. 8 times more means around 5600 crores. But their working capital in actual terms is 58,000 crores. 58,000 crores. So that is a lot of working capital they are requiring here. Their current ratio is 1.3, which is similar to them, but the magnitude of the working capital is drastically different. It is like 10 times. Scalably, if you put the scalability on, it should be 1/10 of what it is. So that means the working capital requirement is 10 times. The operational expense requirements is actually 10 times than that of the Bajaj Auto and Eicher Motor companies. So Mahindra and Mahindra obviously is a four-wheeler company. It is into SUVs and all that. That kind of a setup requires 10 times more operational capital than a company like Eicher Motors. That's what this actually proves. Much more. In fact, if you don't want to scale it, you need much more working capital. If you want to verify this, let's delve a little bit into their balance sheets. So I'm just eyeballing it. We can also write and calculate them. That will be a better way of doing things. So for generating 1.21 trillion of revenue, for generating 1.39 trillion of revenue, they have a requirement of total inventory plus receivable plus cash. This is basically the current assets section, the other assets. So they need current assets of 1.64 trillion. This is for Mahindra and Mahindra. For generating 1.39 trillion of revenue, they require 1.64 trillion of current assets. You can see these are the current assets: inventories, trade receivables, cash equivalents, short-term loans, other assets, etc., etc. Now if we check that for Eicher Motors, for generating 16,000 crores or 16,500 crores, they require 6,000 crores of current assets. So the ratio is quite different. And 6,000 crores, out of which 4 points, this other liabilities, non-controlling interest, you can remove this. Trade payables, advance from customers, other liabilities. If you add this is around 4,500, right? So 4,500 is their current liabilities. You can check it for Mahindra and Mahindra also. So 4,500 compared to 16,000 crores. And in case of Mahindra and Mahindra, this will be somewhere around, if you check, this is for Mahindra and Mahindra, right? Yes, this is Mahindra and Mahindra page. Here, if you go check here, other liabilities. So they have trade payables of 25,000 crores and other liability items of 26.5 thousand crores. So they have 50,000 crore of requirement. 50,000 crore of requirement, right? So liabilities is 50,000 crores, which means one third, almost about one third of the revenues. Assets, current assets is more actually. The ratio is less than 1. If you do sales divided by current assets, the ratio is more than or less than 1. So you can understand there is a huge difference in terms of the current assets and sales and current liabilities and sales. These ratios are drastically different. While for Eicher Motors, it is not so different. For Eicher Motors, if you take the ratio of other assets to revenue, it is somewhere around 2.5. 6,000 and 16,000, right? 2.5, 2.6 around. And current liabilities, if you take it, it will be 0.6, it will be somewhere around 3.2, 3.3 like that. If you divide it, you will find it out. 3.5. So 2.5 and 3.5. While in case of Mahindra and Mahindra, the numbers are drastically different. One is around 1 and the other is around 5. So that is what is creating the huge requirement for working capital. Again, I'll revisit. You can see the assets is around 1. The ratio is 1, right? Or less than 1. And liabilities, if you check out the liabilities, it is 50,000 or 51,000 with respect to 1.4. So it is somewhere around 3. So liabilities are a lot less and current assets are a lot more. So that is what that gap is creating the huge requirement for working capital. So in terms of working capital requirement, Mahindra is having a hugely greater number. That's why. Even for Tata Motors, it is the same. Only you can see a curious thing in case of Maruti Suzuki, they are having a negative number here. Now this is basically they are doing their business in credit. This means Maruti Suzuki is doing their business in credit. They are not requiring any working capital. They have 3,269 crores of working capital in credit they are getting from their distributors or suppliers or creditors or whoever may be. So that's interesting. You can see here their liabilities are more, 29.5 thousand crores, 22.4 thousand crores of assets. So that's very curious. So this reminds me I should check their cash conversion cycle also. Cash conversion cycle. Yep, that is also negative. So they are doing their business entirely in credit. If you remember cash conversion cycle, let me get back to the board. So cash conversion cycle, this is basically days inventory on hand, days receivables in hand minus days payables in hand, right? So if this payables part is greater than the sum of these two, that means you are actually doing your business in credit. And this is the place where it becomes negative. Amazon has this characteristic. It has a negative cash conversion cycle. If you have very dominating place in the market, this can be a good thing if you keep it under limits. This can be a counterproductive factor also, because it might mean you have liquidity issues, you are not able to pay off. But that is not the case in case of some company like Maruti Suzuki. Surely, we have seen their performance numbers. Now we get back to iShare and see what is their kind of take on this cash conversion cycle. So you see, we are doing it organically. We are not doing it in a mechanical way, right? We are making it, see, they are also in a negative situation. They are also doing their business in credit. Their short-term working capital requirements are very, very minimal. While if you do it for Mahindra and Mahindra, let's see what is their status. This is Mahindra and Mahindra. Cash conversion cycle. They are also negative here. But somehow they have created so much difference in terms of their current liabilities and current assets that the working capital requirement is huge. In terms of cash conversion cycle, they are also negative. How is these paradoxical things happening? Let us try to understand. So their inventories is 18.590. Let me calculate their cash conversion cycle only. So inventory turnover, let me calculate. The inventory turnover is COGS by inventory, average inventory, right? This will be equal to, they have not given a gross margin. So let me check what is their gross margin. Gross profit margin last quarter. So 41.7%. So 60% of the revenues is, I can say, is COGS. So 60% of 139078 comes to be 0.6 into 139078. This is equal to 83,446. 83,446 divided by inventory. The inventory is 16,855, 18,590. So this is around 17,500. Let me average it out. 17,722. This is coming as 3446 divided by 17,722. This is equal to 4.7. 4.7. Therefore, days of inventory in hand is 77.51. 77.51. How I did it? 365 by inventory turnover. Now we will do receivables turnover. This is equal to sales by average receivables, right? So sales is 139078 and average receivables, let's find out. Trade receivables 7,200, let's say. 7,200. So 139078 divided by 7200. This is equal to 19.31. Therefore, days of receivables in hand is equal to 18.9. 18.89. Days payables. Purchases during the period. Material cost, manufacturing cost, 60% again. So purchases are not separately mentioned. We will use the COGS itself. 83,446 by average payables. This is equal to average payables. Yes, here it is 23,836, 25,666. 83,446 by 24751. This is equal to 3.37. So days payables 108.26. Now you have 18.89 here, 77.51 here, and 108.26 here. 77.51 plus 18.89 is equal to 96.40 minus 108.26. This is equal to 11.86. So our calculation is coming to 11.86. Their data is saying 11.3. So we are nearby. Some calculation has happened. Some calculation anomalies have happened. But we are close by 11.86. Could be because we have taken approximations here. This could be the reason. But any which ways, this is sufficiently credible. If you do a little bit of exacting, it may come to 11.3, or their data may also be approximate. So we do not need to worry much over it. Coming back, we were currently talking about the liquidity ratios only. Now it's time we move ahead a little bit and go and check out our current ratios. The solvency ratios. The solvency ratios are two kinds. One is a coverage ratio and one is the debt ratios. So we have to see which are the ratios. A little bit we'll check. Debt ratios are debt to asset, debt to equity, financial leverage, debt to EBITDA ratios. Right. Now here, let me go back to this thing. Let me find out debt to equity first. debt to equity. You can see here in a comparative basis, see in absolute terms also this is fantastic, 0.02. They have practically no debt. Maruti Suzuki, you can see 0.00. They also practically have no debt. Mahindra and Mahindra, yes, they have 1.61 is a high number. Tata Motors 1.26 again is a high number. TVS Motors also is a high number. Bajaj Auto again in a very good position. Hero MotoCorp again in a very good position. Escorts again in a fantastic position. Ashok Leyland, Tata Motors, Mahindra and Mahindra, they are having numbers which are quite high, and especially Ashok Leyland is in a very high zone. If you check Ashok Leyland's interest coverage, you see it's 2.38. If you see Mahindra and Mahindra's interest coverage, it is 3.3. If you see Tata Motors, it is 3.9. So 3.9, 3.13 are quite marginal, we say. 2.4 is very marginal, 2.38 is very marginal. A little bit here and there, if the profitability goes, you will see this interest is going to eat up all your profits and you will be in losses. That is going to be the situation. That is not at all the situation with iShares. Their interest coverage is 103.24. So their solvency situation and liquidity situation is very much under control. Although their current ratio is 1.15, which is average, but their situation in terms of solvency is quite good. In terms of coverage is also quite good. Solvency, it has to be good because if you see 0.02 is the debt to equity ratio. Now if you try to calculate debt to asset or financial leverage or whatever, a financial leverage ratio is asset by equity ratio. It will come almost equal to 1, which is almost equal to perfect. Like let me tell you, this is average total assets by average total equity, right? Ideally it should be equal to 1. That is, one should have no debt. They are almost near that number, right? 0.02. So it's a fantastic situation for them. The other ratios, debt to capital ratio. Well, capital, they do not have much of the what you can say debt. Let me see what is their capital situation. Capital, total capital employed, 4170. Total capital employed is 4170, and return on capital is 31.1%. Capital employed is 4170. Now let me see debt. How much debt do they have? 419 CR. 419 CR is their debt. Now if you try to calculate their book equity, it will be book value by the number of shares, right? So let us try to calculate that. Their book value is their number of shares is market cap divided by current price. Let's do it. iShares Motors. This is just a rough sheet we are taking. We are not doing any financial modeling as of now. This is number of shares, 128262. 128262 by 4684. 27.38 crores. This multiplied by the book value. Book value per share. This is 659. So their book equity is 18,000 crores. So they have a debt of 419 crores and they have a book equity of 18,000 crores. Right. So if you want to find their debt equity manually, this becomes 419 divided by 18,000 crores. This comes to 0.02. This is how the calculation has been done. See, this is the DE ratio. Right. This is the DE ratio. This is the book equity. Book equity. Total value of the equity. Book value of the total equity. And this is the number of shares. Number of shares outstanding. Number of shares outstanding. I did not say outstanding. Okay. Debt to EBITDA ratio. Let me check out the EBITDA. Obviously, if interest is low, tax is normal. They will not have any exceptionally bad EBITDA. So, but still, let us calculate it. We have found the EV/EBITDA ratio, that is enterprise value EBITDA ratio, and if we find the enterprise value, here it is 1 point. This is the market cap. Basically, they have given a little bit different market cap plus. Basically, the enterprise value formula is market value of equity plus market value of debt minus the cash. So they have come at this value with this calculation. This, if you divide this by this, then you get the EBITDA. Let's do it. EBITDA is 22. EV is 128535, I guess. Therefore, EBITDA, this is equal to this by 22. So EBITDA is 5,842 crores. 5,842 crores. And debt to EBITDA ratio is, if you write debt here, this is 419, right? Debt to EBITDA becomes debt to EBITDA becomes 419 by 5842. So that's like a fantastic number, right? A very low number. And they're generating a return on capital of 31.1%. This is no mean feat. Generally companies need a lot of leverage to get to these numbers, and they generally end up going into counterproductive scenarios because of huge amount of debt. When the market turns around, they are not able to turn around. That's what happens to high leverage companies. So this is not that kind of a company. So you can see 16,000 crores of revenue and 51 crores of interest payments. That's a lot of difference. And they have a EPS of 146 per share. 146 per share. Now we have spoken about the coverage ratios also, solvency ratios also. Let us move a little further. Interest coverage we have done. Fixed charge coverage. Okay, fixed charge coverage ratio. This is about the lease cost. Let me see what is the lease payment scenario of iShare. For that, I don't think they will have the data. I'll have to go into annual reports. So as you can see, friends, they have lease payments of 16.34 crores for 2023 and 19 crores for 2022. Now I cannot see a report for 2024 here, but anyways, even if you take a 20 crore figure for this, their EBIT, let me see their EBIT. What is their EBIT? EBIT 5253. So if you come to calculate their fixed charge coverage ratio, this comes to be around 5253 plus 20 crores, let's say, divided by 51 crores plus 20 crores. So their fixed charge coverage ratio is again awesome. 5253 plus 20 divided by 71, which is 74.26. This is a fantastic number. Okay. So we are done with this thing, the coverage ratios. Now we'll move into the next set of ratios. So which is activity ratios. Now we can come to working capital turnover. Working capital turnover. Let's see. Let's get to this one. And let's take our working capital turnover. Working capital to sales means working capital as a percentage of sales. You have to invert it to get the actual number. So the less the number is, the better it is actually. in this case, because they are actually giving working capital to sales ratio, not sales to working capital ratio. Sales to working capital ratio is basically the working capital turnover. So here what you are getting is this negative number means they have a negative working capital, so they are having a negative number. They are in a different space altogether. Worship of this space, you can say. 7.336. This is a good number. They have a sales which is much more than working capital, but you have to see what is their operating margin, what is their net income, all these things you have to see. That we can do when we analyze Tata Motors. Right now we are centering around Eicher Motors, right? So Eicher Motors, they are having 4.24. So their working capital turnover is inverse of 4.24. 4.24 inverse. This is 23.58. 23.58 is their working capital turnover. So $1 of working capital is producing $23.58 of revenue. You can also do a mapping of net income to working capital also. That will also be quite useful. So their working capital anyways is 700 crores, right? And they have a net income of around 4,000 or 5,000. What was that? 4,000 crores. So 4,001 divided by 700. They have a net income to working capital ratio of 5.7. This is also fantastic. Who is the best here? I think in terms of this, in terms of working capital and sales, I think they are at the top. They are doing the best. Apart from Maruti Suzuki, they are doing the best. They have a very balanced approach towards this, I believe. Okay. So full marks, fixed asset turnover ratio. Let's see. Fixed assets. Let me edit the columns once again. So in terms of asset turnover, I don't think they are doing very good. I think their fixed assets requirement is more than their working capital. Let me check. So let's say a Maruti Suzuki, they have fixed. Let's see what's Eicher Motors has 3258 of fixed assets, and they have a revenue of 16,536. So what we are trying to do here, if you are getting confused in terms of I'm sometimes going into Maruti, sometimes going into Eicher, sometimes into Mahindra and Mahindra, I have started with Eicher. I've started with Eicher because I think it is a good stock with a brand, with a moat, that is with an entry barrier. The bullet bike itself, the Royal Enfield, that has no replacements as of now in terms of its appeal to the people. Yes, Harley Davidson and all that is there, but Royal Enfield has its own place. And once that is confirmed, the story has to be just converted into numbers mostly. And if it is overvalued, obviously you don't enter. But if you find the valuation to be and the valuation to be in a way that the pricing is less than it or at par with it, or there is scope of going upwards, then you actually make a decision. You actually recommend a decision to the client that we can go at it in a certain way. We can go accumulate it in a certain way. Now here we were looking at which of the ratios? The activity ratios, right? Fixed asset turnover ratio, total asset turnover ratio. In total asset turnover ratio, I think Eicher is not doing that well. See, asset turnover 0.78, while Hero MotoCorp is 1.51, TVS is 1.01, and if you check the others, Maruti is 1.42, Tata Motors 1.24, Mahindra and Mahindra is lesser than it, yes, but it is also in the lower half of things only. So in terms of asset turnover, we are not doing that great. The reason being, the fixed asset amount seems to be higher for Eicher Motors. You can see current assets here is 4171. Total assets is almost 6 times. While in other cases like Bajaj Auto, it is less than 4 times. Like 3.5 times. In case of Mahindra and Mahindra, it is 2.5 times. In case of Tata Motors, it is 2.2 times, maybe 2.25 times. In case of Maruti Suzuki, it is around 4 to 5 times. Yes, that again, this is again a case where the difference is high, but this is almost 6 times, which is not the case in any other cases. Ashok Leyland, it is 2 times. Hero Motor Corps, it is 2.5 times. TVS Motors, it is 2 times. But here the fixed asset requirement is, we have to check if there is a goodwill in it which is causing this problem. We have the annual report, right? Let me see. So friends, what we find in the report says, there is around 10,000 crores in other investments, which is the biggest part of their fixed assets, and out of which 6,500 crores is invested in mutual funds, and it is carried at fair value through profit and loss. Fair value through profit and loss. Investments in target maturity index funds at fair value through other comprehensive income. So these mutual funds and ETFs, they are being taken at fair value. They are not taken till maturity or anything. They are equity investments, and they are taken in fair value through profit and loss. And here they have invested in ETFs, target maturity index ETFs, and they have taken it in fair value through other comprehensive income. Investments in instruments at amortized cost. This is also there. This is a small amount. The main amount of around 9,000 crores is in ETFs and mutual funds. So that is a huge amount, and really they do not have otherwise any other reason to have a low asset turnover. Every number of them indicate that they should have like high asset turnover. So what they're doing is, the cash they're generating, they're investing it in mutual funds and ETFs to grow. That's what the impression we get. They are investing in business, that is okay. But whatever extra amount they have, which they are not distributing as dividends, they are putting it in mutual funds and ETFs or similar instruments. Till now, we were oscillating between Mahindra, Maruti Suzuki, Eicher Motors, and also talking about sometimes TVS Motors, Bajaj Motors. Why we are doing this? Because we are trying to have an absolute idea of Eicher Motors, but also compare it with other companies to understand where they stand in terms of each of the matrix. That is also important. So now we will proceed further. Working capital, fixed asset, total asset turnover. Now we'll go into the other ratios also. Profitability ratios: gross margin, operating margin, pre-tax margin, net profit margin. This is going to be fun. I'll just do an edit columns. First we'll have an overview where we will have a comparative look of these things. You can see net profit margin is 24.2, gross profit margin is 46, and operating margin is 26. So 26.17 is the operating margin, and 24.2 is the net profit margin. So impact of tax and interest is much less, right? Impact of tax, depreciation, and interest is almost negligible in case of Eicher Motors. Is it the case in other companies also? Let's see. Net profit margin for Maruti is 9.51%. Operating margin is 13.06%. Gross margin is 29%. In case of Mahindra and Mahindra, net margin is 8.82%. Gross margin is quite high. That means after the gross margin is exceeded, that is after the step of gross margin is taken, there are a lot of expenses which Mahindra incurs, which reduces its margins greatly and reduces it to 8.82% ultimately. So 8.82 is the net profit margin, and operating profit margin is more than double, 17.9%. So in terms of net profit margin, gross margin, and operating margin, I think the income statement of Eicher Motors is looking very, very superior or very, very refined. Their net margin is the highest in the list. That is one thing. Second thing is, their difference between the operating margin and the net profit margin is negligible. It's 26.17 and 24.2. That is brilliant. So theirs, I think, is looking the best in this profitability ratio terms. Pre-tax margin, net profit margin. Okay, we can look at them also. Pre-tax margin. So pre-tax is 5202. Sales is 16535. 5202 divided by 16535. This is 31%. So how come this is happening? If you check their income statement, you will see operating margin is 26%, all right. Then depreciation, finance cost, and there is other income. This other income is 1524 crore. This is what is actually generating the pre-tax margin for them. And this is one of the main reasons their operating margin and net income are so close to each other, despite having a 600 crore depreciation. So what is the source of this 1524 crores? Let me look into their annual report and try to find out. So friends, I have entered their annual report, and here we can see there is other expenses is there, but more importantly there is something called other income, and this is 2023 numbers, right? So we will have to make do with 2023 numbers only and try to find out where from they have these earnings. This is the standalone statement, right? Standalone statement. So the details of the other income in 2023 is in note 30. So we reach out there. Other income: bank deposits, dividend from joint venture companies, grant income on soft loan from Spicot, gain on financial instruments. This is a big number, 301. So half of it is from the mutual funds, right? Half of the income is coming from mutual funds. A little bit is coming from lease. Exchange gain is also there. So 301 is coming from, out of 639, 301 is coming from mutual fund income. So whatever assets, other assets they have created, which is basically investments in mutual funds and ETFs, that is giving them a lot of other income. And apart from that, dividends from joint venture companies, bank deposits and bonds they have invested in. So this is net profit after tax. Okay, we have done that. So we have done all these things: gross profit margin, operating profit margin, pre-tax margin, net profit margin. Gross profit actually makes no sense if you do not have a good net margin. The net margin has to be high. And once again, what we said is the 5202 they are earning, the 31% on the revenues they are earning as PBT, profit before tax, is having a great reason behind it is their investments in mutual funds and ETFs, it seems like. So that is giving them a lot of returns. Half of their other income came from that in 2023. I'm sure in 2024 also the number is going to be similar. So we'll have to wait and watch. Then what other ratios we are looking at? Okay, return on investment ratios. Operating return on assets, return on capital employed, return on equity, return on common equity. So these things again, iShares is doing very, very well here. Return on equity, return on capital employed 31.1%, return on equity 24.2% at a low debt. This is brilliant. Return on assets 18.9%. This is also very, very good. Return on capital employed we have already mentioned. Preference capital is 0. So if preference capital is 0, there is no difference between return on equity and return on common equity. It is the same. If they had preferred capital, then we would have considered it differently. You see here, I repeat again, preferred capital is 0. So there is no difference between return on equity and return on common equity. They mean the same thing. Now we'll get into the valuation ratios: PB ratio, PE ratio, PS ratio, PCF ratio. Okay. Now we come to the other things. PE ratio 32.1. Let me see if PB ratio is there. Price to book ratio will be 4684 divided by 659. 4684 divided by 659. 7.1. Now the industry PE ratio. Industry PV ratio is 7.11. Industry PV ratio is 7.11. They have a book PB ratio of 7.1, which is at par. Now industry PE ratio. Industry PE ratio is 61.7. They are very, very well placed here. They are at 32.1. This is very good. But you have to see which of the companies are at 61.7. So PE ratios you can see here. In the top 10 or 15, they have a ratio of 20, 20, 24, 29, 10, 27, 31, 32, 61, 26, 26, 41, 183. 183 is for Olectra. 30, SML Isuzu is 37, VST Taylor is 24, Atul Auto is 2220. Right. So, what we would say is they are well placed in terms of this, but the industry average which is showing is basically because of a few green vehicle companies which are ridiculously valued. Their valuation doesn't seem to fit the valuation of the company. The pricing does not seem to fit the valuation of the company, and they might mean revert and come down in the future. But we never know. They are at a certain, a peak of pricing. So that is what is, I think, distorting the P ratio of the industry as a whole. So the average should not be taken like this. I think 30 in itself is a decent PE ratio. It is not undervalued, neither overvalued. This is par valued kind of a situation, I would say. Even PB ratio is saying that. But again, we have to see price to sales ratio. Now, in terms of price to sales ratio, you can see the valuation of the companies in the higher range, 7.76. If you see market capital by sales is 7.76. For Maruti it is 2.79. For Tata Motors 0.8. For Mahindra 2.24. For Bajaj 5.48. For Hero it is 2.70. For Eicher it is 7.76. So this indicates a higher valuation in terms of price to sales. Price to cash flow, 129 for Maruti, 18 for Tata. Mahindra is negative because I think they have negative cash flows this year. I think diluted EPS we do not have to measure because they do not have a preferential capital. Yes, cash flow per share, dividends per share, we can look at that. 64 is a high number. You can say 64 is a high number. And I think Eicher is one of those companies which has good free cash flows, positive free cash flows coming out. Market cap to cash flow. In this terms also, the 34.4 is one of the higher numbers. You can see here. Yes, it is one of the higher numbers. I would say it is one of the higher numbers. There are numbers like 98.85, 60.9, but that can be either due to low free cash flows or due to extremely high pricing levels. 34.4 is a higher number in absolute terms. But that does not mean it does not have an upside. Depending on the market situation, it can keep on growing in momentum very easily. But right now the number seems high. Let us look at the dividend situation of Eicher Motors. See, they have a dividend payout ratio of around 20% in the first 5 years, or 17 to 20%, or 15 to 20%. But for the last 4 years, they have 34-35% payout ratio. If you want to ascertain their growth rate, sustainable growth rate, you can write this. Sustainable growth rate. This is given by return on equity multiplied by 1 minus payout ratio. So this is 0.24, 24% multiplied by 0.65. So they have a sustainable growth rate of right now of 15.6%, which is quite decent, guys. You will see when we talk about free cash flow, when we learn about free cash flow, we'll be using items like this and finding out the valuation of Eicher Motors also. So that will also be done. But for now, we'll stop here. We will not go ahead and try and calculate the valuation. We're just doing a relative valuation and pricing of the company. We're just looking at it. We are not yet arriving at a situation where we are able to conclude. We are just observing everything, having an overview, slowly building it up and going deeper and deeper. Right now we are still on the surface, scratching the things. In valuation, basically there are two things. One is the story and the second is the numbers. So the numbers right now are helping us build a story, how good the company is. These numbers, these way of finding out the numbers, finding out the trends, finding out the comparative analysis, what this does is basically it helps us find out where the company is located or situated in terms of the entire industry. Is it going upwards? Is it trending downwards? Or what is it doing? That is what we are looking at. And Eicher Motors has its unique category. The CC of the bikes are completely of a different range than a Hero MotoCorp or Bajaj Auto. It has a different range of bikes. So we are not in collision with anything that we have to find out how much market share of which brand is competing with which brand and what is the clash this month and what is the clash next month. We do not have to go through those hassles. If we start comparing TVS Motor and Hero MotoCorp, we have to go into each variant and try and find out their market shares. In 125cc, what is their market share? In scooty segment, what is their market share? In 150cc, what is the market share? In the higher end, what is the market share? What is the comparison between Pulsar and Charisma and things like that? But you do not have to do such things in case of Eicher Motors because the CC itself is different. The range of the bikes, the branding itself is different. We are buying something different. So this problem is not there. But you cannot avoid the problem being a research analyst. We have to do it in case of valuing some other companies. Here I just want to focus on the ratios and the balance sheets, and we need a company which has lesser complications in terms of competitive scenarios. Even in case of valuing, say, Hero MotoCorp or Bajaj and TVS, you have to bring in Honda also in the picture. Their numbers are also important because they are also taking up market share in some places. They are also losing market share in some places. So all those things complicate the scenario. In case of Eicher, we are actually little aloof from all this. Dividend payout ratio, retention ratio, sustainable growth ratio. We just looked at that, right? We will now do a few credit ratios. EBITDA interest coverage, fund from operation to debt ratio, free operating cash flow to debt ratio, EBIT margin, EBITDA margin, debt to EBITDA, return on capital. So first is EBITDA to interest coverage. We have already calculated the EBITDA, I guess. EBITDA is there. And our interest coverage is earnings before interest and taxes. Divided by interest. So 4327 plus 1524 minus 598 divided by 51. This is 103. Interest coverage is 103. EBITDA by interest coverage, this is equal to EBITDA by 103. This is 56.72. So friends, funds from operations, we are trying to find out this ratio. Funds from operations to debt ratio. For that we have to measure the funds from operations. Now how do we do that? We are trying to do that through this formula. Funds from operations is net income plus depreciation and amortization plus loss from sale of assets minus gain from sale of assets minus net interest income. So this data is very much available in the cash flow statements, friends. So you can see gain on disposal of property is minus 1.34 crores, loss 0.89 crores. Then there is interest income recognized in profit and loss. This is 176.58 crore. 176.58 crores. Net gain on financial instruments at fair value through profit and loss 301.12 crores. So this one we also can include 170 because this is not operational. This is not part of the operations, right? So we will include interest income here. Net gain from this we will subtract. Dividends from joint venture companies, this is not operations. But we will not be reducing it because they form part of the operations and they are giving their dividends from net income. So we are not going to subtract this one, but we will subtract interest income, gains and losses from fair value through profit and loss instruments, and gains from PPE sales and losses from PPE sales. These things will adjust, right? So how do we do that? And remember friends, we are doing it from the balance sheet of 2023 because we are not able to use the 2024 annual reports because it is not available currently. So let us calculate it, friends. 3508 or net income from this year is net income from 2023 is 2914, which is the net income, minus 176 minus 301 minus 1.34, which is the gain from PPE sales, plus 0.89, which is the loss on PPE. So the answer is 2595, and we will add the depreciation to it. Depreciation and amortization expense, this can be found here also. Depreciation and amortization, this is 526 plus 526, this is 3121, 2914. Now the formula is you have to subtract the gains from sale of assets. So gain on disposal of PPE 1.83 minus 1.83 plus depreciation plus 526.21 plus loss on sale of PPE plus 2.14. Interest income, if there is an interest income, here it is, interest recognized in profit and loss 176.48 minus 176.48. Also gain on financial instruments fair value through profit and loss, this is also not operational, so we'll subtract this also, minus 301.12. so the fund from operations value is coming at 2962.92 2962.92, and the total debt is 419 CR. So 2962.92 divided by 419 CR, the value is 7.07. So let me write it. Fund from operations, net income plus depreciation amortization. If you look at this data, you add depreciation, then you subtract the gains, you add the losses from PPE sales, then you subtract the gains from financial instruments 301.12, you also subtract the interest income, and what you are left with is fund from operations, right? So this is 2914 plus 526 plus 2.14 minus 1.89 minus, again we look at the annual report once, 301.12 176.48, 301.1 minus 176.48. This entire value you divide it by the debt, which is 419 crores. You can check it. This is the current debt though. The current debt 419 crores. What was the debt amount in 2023? We can check that also and use that also. So debt preceding year was 288 crore. Now we have to divide. So debt preceding year was 288 crore. So this entire value once we calculate comes to 2962.9. This divided by 288, this comes to 10.29. 10.29. So this is fund from operations to debt ratio. Free operating cash flow to debt ratio. Free operating cash flow, this is again CFO adjusted, divided by total debt. CFO cash flow from operating activities, this is 3724. We will be doing the 2024 number only because we have it. 3724 divided by total debt. Total debt is 419. So 3724 divided by 419 is 8.88. We write it 3724 divided by 419. This comes to 8.89 approximately. EBIT margin, EBIT by sales. EBIT was 5052 or something. Let me see. EBIT 5253. Sales is 5253 divided by 16536. 5253 divided by the revenues or the sales, 16536. 16536. This is equal to 16536. 31%, 31.76%. So this is how we calculate. These are very easy numbers to calculate, I guess. You'll be able to calculate it easily. Right, friends? So that's how we do it. Then what are the other ratios that we calculate? Z score, no. So this was about the ratio analysis, and through that we have already understood much about the balance sheet. But in fact, through that we have understood much about the balance sheet, income statement, and cash flow from operations also. But we will do a separate analysis of these, and we will do it right now through the trends analysis, right? So first, let us start with the balance sheet. In balance sheet, the most essential things are the trends of inventories and receivables with respect to the sales. So we will copy these two terms, inventories and receivables, and we will also take in the sales here, and we will try to understand the trends. Now, inventory to sales ratio. So inventory to sales ratio, this is equal to this number by the sales, inventory number by the sales. Now we stretch it. So you can see 7, if you turn it to percentages, and increase the decimals, friends. 7.7, 7.3, 4, 5%, 5%, 4.5%, 6.5%, 6.2, 10%, 10%, 8%, 8%. It's still, the numbers are very much within control. A little bit increment has happened in terms of inventories, I would say. Trade receivables. Again, receivables to sales ratio. This is equal to receivables by sales. 7%, 6%, less than 1% for a long time, then 1%, 2%, 3%, 2.5%. This is fantastic. They have really brought things under control in terms of trade receivables, right? They have really brought things under control. Again, I'll cross check if I am making a mistake here. Let me see the numbers once again. Trade receivables, yes, 374 is the last number, 512 is the first number. Yes, they have made real impact in terms of clearing the receivables. So this is one of the cream companies, I would say, in terms of the receivables ratios. So we are right now combining numbers from profit and loss statement and balance sheet to understand the situation of a company, right? Now let's say we want to understand how efficiently the fixed assets are being used. So we will add the fixed assets also. Fixed assets to revenue ratio. So revenue to fixed assets. This number is sales divided by fixed assets. See, it was 4, 3, 7, 8, 5, 5, 3, 3, 3.5, 4.2, 5.36, 5. So they have maintained an average of around 5.2. And these numbers are decent, I would say. Cash reserves. Cash reserves, they had reached up to 5830, but they have made investments, and right now they are at one of the lowest currently, which is in fact not a bad thing necessarily, because 5,830 of cash in hand means there is stagnancy. You are not finding options to grow. Either inorganic or organic options have to be found to invest the cash and grow. Otherwise, this cash is basically going to stagnate or impede your growth rate. So they have found ways to invest, which is a good thing. You will see investments here, investments purchased have increased. 9,000 crore, 7,000 crore, 3,000 crore, 8,000 crore. So they have increased in the last 2 years. 9,000 crore, 6,000 crore, like that. They have also sold investments, but they have bought investments parallelly at large amounts. What those investments are, we have to check. Purchases of debt mutual funds. This is 8,000 crores. Debt mutual funds is 8,000 crores. Maturity proceeds from fixed deposits. Purchase of debt mutual funds, again, proceeds from sale of debt mutual funds. Purchases of debt mutual funds. This is 8,665 crores, almost more than that. Then there is investment in fixed deposits. That is another 753 crores. Investment in equity instruments. That is 443 crores. Payment for PPE and intangible assets. That is 682 crores. So this 682 crores is for internal upgradations, and the rest of the amounts that you see is basically invested in proper financial instruments. There is no inorganic growth or anything like that. The thing is, they have an exclusive brand, and any kind of inorganic growth may not fit with it. So that is a constraint they have. But as long as their revenues are growing at a decent rate, you can see their compounded profit growth 10 years is 27%. Their compounded sales growth 5 years is 11%, 3 years is 24%, 10 years is 9%. So initially they were not doing that great, but right now they are figuring things out and they are growing faster and faster. So, which is a good sign. So they are growing despite they not getting opportunities for inorganic or organic growth in that sense. They are still growing. They are upgrading internally with intangible assets and all. But that is not very much capital intensive and all. They are having the capital, and intelligently they are investing it in mutual funds and equity instruments and getting returns out of that. Which is why you will see they have this other income segment, which is actually huge. This other income segment, you can see this. This includes large percentages of earnings from those investments also. So that's how they are going about the things. Then what we will be looking at is how they are. We have already seen how efficiently they are using their working capital, right? They have a working capital of 700 crores and they have net income of 4,000 crores. So which is fantastic. 4,000 crores divided by 700 crores is 5.71. That is a fantastic number to have. Next, so fixed asset covered, working capital covered. Working capital means we have taken together the short-term liabilities and short-term assets. Now we will look at borrowings. Borrowings mean long-term debt. Long-term borrowings. Long-term borrowings, they have very negligible amount in such terms actually. So that is not much of a worry. So balance sheet is covered. We have checked out long-term borrowings, short-term borrowings, working capital, fixed assets. That is all covered. And we have scrutinized inventories, receivables with respect to sales. So balance sheet is covered. Profit and loss we have already done in the ratio analysis, gross margins, operating margins, net margins, profit before tax. All these things we have already counted. Other income is also taken into account. Interest we have already taken into account. Depreciation we have already taken into account. So this is also covered. One thing we have to look at is the materials cost. Now you can see initially the material cost was 72% of the expenses. 72%, 66%, 56%, 55%. This has continuously reduced. This has continuously gone down, and material cost has gone down to 54% from 72%, right? So which means as a proportion of the revenues, as a proportion of the sales, their cost has gone down, because you can see other costs have not increased. 7%, 8%, 7%, 9%, 7%, 7%. Other costs 10%, 11%, 12%, 9%, etc. etc. So this is not a cumulative, this percentage is basically a percentage of the revenues. This is not the proportion of the expenses in material that is going. This is basically a percentage of the revenues. And as a percentage of revenues, the material cost has gone down, which means their brand value is continuously going up, and they are able to pass on the prices. They are able to pass on the prices to customers and at the same time get growth in revenues and volumes both, which is a fantastic sign in terms of future growth, which is one of the rare cases, one of the cream cases you will find in stock markets. This kind of coincidence or synchronicity is not very common. This is rare. Okay. So this is done. We have checked out the material cost, profit and loss, and balance sheet is done. Free cash flow, we have not gotten into it yet, so I'm a little uneasy getting into it. Free cash flow is a very important metric. When we value Eicher Motors, we will be valuing it through free cash flow. So for now, we'll be leaving it. We'll not get into it. But you can analyze the individual elements, that they are investing in different parts. They are also selling investments, but where they are investing, what is their investment style. So they are internally trying to grow, because their brand is so exclusive. They cannot find easily inorganic growth options. It's not like a steel company which can find another broke steel company and take it over and modify it according to them and start running like Mr. Mittal and like Tata Steel. It cannot happen like that. It's a unique brand and they do not find such options very frequently. In fact, they are not willing to get into such things. What I see is they are buying intangible assets and they are buying their own PPE and they are trying to grow by themselves, and which is serving them quite well. Rest of the cash they are using for investments. They are keeping little bit of cash for their own contingencies. That's all. And their confidence also shows that they are able to use the cash for investments in large quantities. Also, one thing we have noticed is dividend payments have gone up. Dividend payments have gone up from 15-20% to 35% ranges. And along with 35% range with no debt, they are going to be able to have a sustainable growth rate of around 15% at least for the next 10 years. That's what I can see. So these are fantastic combinations. If you ask in an absolute term, these are fantastic combinations. And if the pricing is correct, with respect to the value, this is a very good investment to make. Again, we just come back to the cash flows. This is cash flow from investment activities. We just spoke about it. Fixed assets purchased. This fixed assets generally comprise both of property, plant and equipments and intangible assets. What we saw in the consolidated statements. Then cash from investing activities, cash from financing activities, proceeds from shares. So they are having some proceeds from shares, proceeds from borrowings. They are taking borrowings also to certain quantity. Repayment of borrowings, they are also doing that. Dividends paid, see, the numbers have increased drastically. Recently. So that is one more observation. We are not going to calculate free cash flow in this in this assignment, guys, because then we will deviate. We are just doing an overview, just taking a qualitative understanding of the thing. Valuation will proceed. This is the way of doing valuation, or this is the way of assessing a company, overall situation of a company, that you are seeing the numbers and you are trying to understand what is the story behind those numbers. For example, they are not doing inorganic growth. For example, their material cost as a percentage of revenues is coming down. What is the story behind that? Their receivables are continuously coming down with respect to sales. What is the story behind that? They are increasing the dividend percentages. What is the story behind that? Their net income percentage and their operating income percentage are very much near to each other. What is the story behind that? So this is the way we are trying to decipher from the numbers what is actually happening on ground. Trying to understand. We may be wrong, we may be right, that is different. But we try to understand to the best of our capacity what is going on inside. The product, we already know about it. I hope you know about it. It's heavy, high cc bikes they are making. Let us talk about a few threats also here, friends. So for example, for these bikes, for the bullet bikes, one of the threats is regulatory threats, environmental threats. The entire ecosystem for the automotive sector is moving towards green engines. And one of the USPs that Bullet has is basically the sound of the engine, which is an IC engine sound. This sound will not be available if the engine is replaced by a lithium battery. So that is one of the things they have to figure out what they're going to do. They have launched bikes. We have to check what is the number of sales they are having in that segment, what is the growth in that segment, and how they are faring in there. Apart from that, till the time lithium batteries become mandatory, that is a long way ahead. We will be coming to upgraded versions of IC engines, maybe, which will not pollute the air anymore. There will be zero carbon kind of engines. So that kind of you can say that kind of runway is there, especially for two-wheelers. The regulations might be tighter for heavier vehicles which create more pollutions, like 6-wheelers, 8-wheelers, 12-wheelers, 16-wheelers. For all those vehicles, they will come first. Then maybe they will come for the 4-wheelers. Then maybe they will be coming for the 2-wheelers. So it depends on what quantum of pollution is being generated by which segment. That research will also play a part in this. So we have to take care, we have to understand all those things. This information gathering and all will be actually the part of our annual report reading and research report making. So we'll be doing it in the subsequent quarters or subsequent weeks. But before that, we have understood what is annual reports. We have understood what is balance sheet. We have understood what is income statements. We have understood what is cash flow statements a little bit. The introduction has happened. We have understood what are ratios. And the next task is we will try to understand a little bit about the annual reports. How to read them, what are the segments, which segments to look for, and what are the information that are available, where to look for them. So this we'll do in the next assignment. For now, our assignment, as I have shared with you, is basically analyze and make your remarks. Make your remarks of those stocks, that what are they doing. Like I try to create a picture from the cash flows, from the profit and loss statements, from the ratio analysis, we try to create a story. Try to create a story what is going on for that company from that number analysis. And this is going to happen for maybe one stock from each sector, two stocks from each sector, 3 or 5 stocks. How many stocks you do, that is up to you. We do a comparative analysis also, and we go in depth and do absolute analysis also. So for ratio analysis, I would add one more thing. For ratio analysis, comparative judgment is also very important. Like we saw current ratio, like we saw asset turnover, like we saw the cash conversion cycles. So these things, when done in comparative fashion, you get the trend of the industry also. You see that Maruti is having negative working capital. So that is very surprising. And you see that many of them are having negative cash conversion cycles. So that is also a surprise. You did not know it. You entered the number and then you found that they are working in negative working cycle, which is a good thing if they are able to sustain it and without having credit crunches. That is a good thing when you don't have a credit crunch. What I mean to say is, you are not having a negative cash conversion cycle because you are not able to pay the suppliers. That should not be the scenario. You should have a cash conversion cycle which is negative because you have a bargaining power against the suppliers, that I'll be paying after these many days. Otherwise, I'll choose somebody else. That kind of bargaining power you have, that is good. But how much you are going to use that, that is also a questionable thing, and that is, the company is the best judge of that. So that's about it, friends. Do the assignment. All the best for that. And we will meet next week also. If you have doubts in middle, definitely get in touch and we will be working on your doubts, all of the doubts, till all of those are taken care of. Thank you.
So, guys, try this assignment surely at home. If you come across doubts, share in the comments. I shall respond. For those who have enrolled to the internship, share your assignments on the mail ID given to you. The enrollment link is given in the description. Hope you enjoyed this video. If this video added value to you, please like the video and subscribe to the channel. Share this with a friend who is interested in finance and investing. See you in the next assignment.